What's going on, everybody? This is going to be a little more difficult than I thought because of the equipment I'm dealing with. I need to get a camera stand or something if I'm going to be doing this moving forward, but it's January 13th, Thursday, 2022, and just wanted to take a few minutes and show you the differences between a fixed rate and an ARM. ARMs have big advantages over fixed rates. Fixed rates have their place too, but right now as rates are rising, ARMs are a really good option, and I will show you why here in just a few minutes. So I'm going to give you two scenarios here. We got the 10-1 ARM and we got 30-year fixed. So this is going to be assuming that we have the same loan amount, $400,000, and we're going to assume that these are the same borrower. They have an 800 credit score. So 800 credit score. Sorry, my chicken scratch if you're having a hard time reading it. It's just how I write. So 800 credit score, $400,000 loan. Right now, we're going to assume that we're taking cash out because I did one of these yesterday and I know the rates are accurate. So 800 credit score cash out, this 30-year fixed is 4% on a Fannie Mae or Freddie Mac 30-year fixed rate loan. That will equal to a payment of $1909.66 a month. This is just principal and interest. It does not take into account escrow. On this side, we do a 10-1 ARM. It is 3%. The payment on that is $1686.42 a month. So the difference there is $223.24 per month. So just to give you a little bit of an explanation on what an ARM is, I probably should have done this first. I'm only doing one take on this, so if I make a mistake, you'll just have to deal with it. So the 10-1 ARM, basically an ARM stands for adjustable rate mortgage. The numbers on the ARM dictate how the ARM performs or what happens when it adjusts. So the first number tells you what the fixed period is. So in this example, this is a 10-1 ARM, so it's fixed at the 3% for 10 years. It's not going to change. There's no prepayment penalty. You can refinance within that 10 years. You can let it go past 10 years. Just know that after 10 years, the one dictates that it will adjust every year after the 10 years. So every year, the rate will change. Now, this particular ARM is what the specs on it is what's called a 2-4 cap. So it will adjust after the 10 years, it'll adjust up or down by no more than 2%. So if it starts at 3, the first year it can't go higher than 5. And the 4 is the lifetime cap. So it can't go more than 4% higher than the initial rate ever. So the lifetime cap on this is 7%. I wouldn't worry too much about this because the reason why I'm offering this and offering this comparison is on average, people stay in a home loan in the United States between 3 and 5 years. So either you're going to sell your house or you're going to refinance out of the loan that you're in now into a different one for various reasons. Could be to lower rate, could be divorce, could be you need cash out to put a roof on your house. Lots of different reasons to refi, and in the United States it happens every 3 to 5 years. So 10 years you're pretty safe. More than likely you're going to refinance anyway. So why not take advantage of the lower rate? And I'll show you how much that'll save you here in just a second, but I just wanted to go back into the ARM and what happens when it adjusts if you stay in it that long. So basically, after the 10 years, it adjusts by what the margin is on the arm and what the index is that we're using. I don't have accurate numbers on this. I could pull it up here in just a little bit, but I'm going to guess just for now because I know I'll be pretty close. But on this loan, the margin is 2.75%, and the index is the 1-year treasury. And I think the 1-year treasury yesterday was like, don't quote me on this, but I think it was 0.430. It could have been higher than that, but we're going to go with that for now. So let's just say that this loan was adjusting today. It's going to adjust the margin plus the index. So 2.75 plus 0.43, that's almost a half. So we're just going to round that up to a half. Your rate would be 3.25% if this were year 10, after year 10, and it were adjusting right now. It would adjust to 3.25, which is still lower than the 4%. But that just gives you an idea of how ARMs work. That's really not what I wanted to show you, because I'm assuming that you're going to refinance within this 10 years and you're not going to have to worry about the adjustment. But let's go back into how much it's going to save you. So you see right here, just in the monthly payment, it's going to save you $223.24 every month. And then if you take this $223.24 and multiply it times 120 months, which is 10 years, that is $26,788.80. That's your savings on the ARM over the fixed rate after 10 years. I'll say savings after 10 years. Okay, so that's not your only savings on the ARM. You're paying a lower monthly payment, and even with the lower monthly payment, because the interest is lower, you're also paying more towards principal. So after the 10 years, on the 30-year fixed, your principal balance, and this is assuming you're only making minimum payments, like you're only making this $1909.66 every month, and that you're not making a penny payment more than that. But after the 10 years on this $400,000 loan at $1,900 a month, you will owe $315,000. That's how much you'll owe on the loan after 10 years of payments on the 30-year fixed. On the ARM, at $223 a month less, you will owe $304,000. So you're going to pay $223 a month less on the ARM, and you're going to pay the principal down by $11,000 more dollars than on the fixed. So $11,000 principal pay down. So we'll take just those two and those added together, $38,788.80. This is how much you save on an ARM over a 30-year fixed after 10 years. 39 grand. It's pretty big savings. It's something you should consider. Now this is assuming you have perfect credit, 800 or higher. Actually, this would apply if you have a 740 or higher. Anything over 740, this would apply to that. I'm going to erase this real quick, and I'm going to do another one that will really show you how much you can save, especially if you don't have the greatest credit. Because this is what's considered a 10-1 conforming ARM. So as long as you qualify for this loan, regardless of what the rate is, you can go with this loan at the 3%. So on this one, we're going to assume that you have a 650 credit score, which isn't terrible. But if you got a 650 credit score, you either have a thin file, so you don't have a lot of credit, or you've got something negative in there. So you've got late payments, you've got medical collections, whatever it may be, you've got something on your credit that's lowering your score. So on this 30-year fixed, on a $400,000 loan, we'll go with the same numbers, 400,000. On a 30-year fixed with a 650 credit score, you're looking at 4.625% on a cash out. And this one's still going to be 3% again. So we'll go ahead and put the same numbers down for this one because we already know them. The 3% was 1686.42. And on the 4.625, that payment is $2,056.56. So you can already see the difference. The difference in that is $370.17 a month. This is $370 less a month than this is. This will equate to $44,416.80 after 10 years. And like I said, just like on the other one, that's not your total savings. You also have to take into account that you're going to pay more down towards principal on this arm than you are on the 30-year fixed. So the balance at the end of 10 years on the 30-year fixed at 4.625 is $321,000. On this one, if we remember, is 304. 21 minus 4. 17,000. It's early. Sorry. 17,000. Add those together, we get $61,416.80. So the arm is definitely better for you if you have a lower credit score. I mean, 650 technically. As long as you qualify for this, you could probably go down to a 620 credit score and still be able to do this. When this goes down, basically on a conventional 30-year fixed loan, there's kind of a break-even point that a lot of times, not always, but it depends on your income, because if you're super low income, there are protections there that will not affect your interest rate as much. But generally, if your credit score is below a 680, a lot of times it's more beneficial for you to go on an FHA than it is on a Fannie Mae or Freddie Mac conventional. There are lots of drawbacks to FHA. That's a completely separate video. We could do that if you guys are interested in it. But generally, this 650 credit score, the interest rate on this, if you were on a FHA loan, would probably be in the 3.125 range, something like that. Pretty similar to the adjustable rate. But on a $400,000 loan, you're paying mortgage insurance forever on that, and it's at a really high rate. Probably just roughly in my head, about $300 a month you're going to pay in mortgage insurance on this FHA loan. So not a great option, especially at that loan amount. But just wanted to go over that with you and show you that there are real advantages to the ARM over the fixed, especially with rates going up right now, and they're only going to go higher. If this was helpful, let me know. I was going to do a Facebook Live video. I did do this in one take. I didn't do it more than one time. But I was thinking, I have a YouTube video or YouTube channel, and I have like 1,500 subscribers to that channel, and I haven't posted a video in like 5 years. So I might take this, stick it on YouTube as well. Because I did, on the way here to work this morning, I did pull up a couple videos on differences between ARMs and fixed rates. And there's not a lot of good information out there. And there's a lot of false information out there. But if you're planning on refinancing in 10 years or less, which 90% of America does that. Nobody stays in a home loan for 30 years and doesn't refinance. It just doesn't happen. I know there's instances where it may happen. And if that's the case, I still think the 10-1 arm is a better option because of the savings here, especially on this option with the lower credit score, because you're going to save $61,416 after 10 years. The cost on $400,000 to refinance is probably around $7 or $8 grand in closing costs. So in 10 years, even if you're going to be in the home for 30 years and you don't need any cash out, you refinance again on a new 10-1 arm that may be a slightly higher rate, but even if you have to pay $7,000 10 years from now to gain yourself $60,000, that's a really good investment. And before we go, I'm going to show you one other thing, and we can do another video about this too. There's this thing, it's called house hacking out there, and a lot of people are doing it right now. And just so you know, assume these people only owed $200,000 on their house, and they're pulling out $200,000 in equity. Maybe they're doing remodel, maybe they want to buy another house. Particularly if they want to buy another house, know that when you do a cash out refinance, that is a non-taxable event. So that's not considered as income. You don't pay taxes on that money. I'm not an accountant, don't quote me on that, but I'm 99% sure that's a non-taxable event. So that $200,000 is cash free. I'm going to say income, but it's not considered income. You can do what you want with it. So basically, let's say that house was worth $550,000 when you refinanced it for $400,000. We're going to say that house is going to appreciate in value by 5% over those 10 years. So if you take the 5% times the 10 years, 5% of 550, let's see, 550 times 0.05, 27,500. 27,500. This is how much the value of this house is going to go up every year on average. It went up even higher than that last 2 or 3 years. I mean, it's been up by as much as 14% last year, I think. So we're just assuming 5%. So 27,500 times 5 is, what's that? 100. We're just going to say 140,000. It could be a little off, but that's pretty close. So your $550,000 house after the 10 years is worth 140,000 more, so 690,000. So you got a $700,000 house after 10 years. That on the arm you only owe 304,000 on. So if you remember back to the first one, you saved 38,788 by going with the arm. So actually your net worth will have gone up after 10 years by 140,000 plus the 38,000. So you will have actually made plus 38,000. We'll just say 180,000. So in 10 years, your equity, or what you're worth, or what you would have access to as far as funds, if you did a cash out refinance again in 10 years to pull more equity out, you basically earned $180,000 in 10 years. And you didn't have to do anything to earn that other than just upkeep the house. So there's a lot of different videos we can do like this. If you have any ideas or want me to break something down for you in general, let me know and I'll work on it. I see this a lot, especially right now with rates going up. This is a really attractive option. The ARM rate does change. That rate 3 weeks ago, a month ago, was 2.5%. It went up to 2.75, and it just went up to 3% on Wednesday, yesterday. So that does change. It does continually go up. As the fixed rate goes up, the ARMs will go up too. But a lot of times you can get an ARM for 1 full percent lower, sometimes more than the fixed rate counterpart. So hit me up if you have any other questions. You can private message me on Facebook, If I put the video on YouTube, put a message in the comments. My work number here, MidFlorida Credit Union, 863-688-8443, extension 1747. My name's Chris.Senterfitt. Talk to you later.